Good afternoon and welcome to a live panel discussion co-hosted by Independent RX and Independent Pharmacy Cooperative. Now today's webinar, Pharmacy Tax Planning, is the third installment in a four-part series that we're bringing you here in 2022 to help you thrive on the business side of independent pharmacy. I'm Brandon Bormans, a marketing program manager with IPC, and my role with the company is to develop and execute initiatives that help educate and empower member pharmacies and attract new ones. My role here today in this joint effort is going to be to moderate this, what we feel is a very important discussion on pharmacy tax planning, a topic that some people may prefer to avoid. I'm certainly no expert on tax planning and accounting, but fortunately we have three people here from Independent RX who are. At this point, I'd like to bring in Owen Bondurant, partner and owner of Independent RX, along with Rich Danoff and Jim Sunderland, both of whom are CPAs with Independent RX. Gentlemen, welcome.
Thank you. Glad to be here. Glad to be aboard. Yeah, this is our third installment, so we're going to talk taxes today. My name is Rich. I'm a partner here with Independent RX. Independent RX, for those of you who don't know us, we kind of cover a full life cycle of pharmacy. We were former pharmacy owners. We had, at one point, I think 16 stores across 3 states. We now currently have 2 stores, a long-term care, a hybrid compounding store, but we cover the buy start side of the business. We cover the ongoing, which is accounting and tax work and operational support. And then at the end of the life cycle, we also help people sell stores. So we have a brokerage side of the business. But again, my name is Rich. My background is I was at PricewaterhouseCoopers quite some time ago, back in the day doing public accounting work. After leaving, after about 5 years of public accounting, was also in private industry. Introduced to pharmacy probably 15 years ago and worked to grow from 3 or 4 stores up to the 16 stores, had a lot of transactions, did a couple big sales and have sold both to chains and independents, bought, opened, backfilled, done a lot of that work. So, and that's transitioned nicely into, helping other people operate and own stores. And so, we focus on my side of the business, and Jim, we're on the accounting and ongoing side of the business.
Hi, I'm Jim. I'm the director here of tax and accounting, and I've been here for a couple years now. I was really brought in to kind of build the tax department and lead that, and of course I work on the accounting side as well. But my background is that I started off in public accounting back at PricewaterhouseCoopers as well. It wasn't called that when I was there, but that shows my age, right? So I've been around a while, but I was in public accounting about 10 years, and I worked in industry since then until I came here. And really the last 20 years before I came here, I was in a role of CFO at 3 different companies. So I bring a lot of experience here, and then glad to be here and working on taxes and leading that. Work with clients a lot as we go through the year on tax planning and just helping them with issues that's come up and everything, and help them get through this stuff. So,
and I am Owen Bondurant. I am not an accountant, which is why I'm here. I'm a partner in the company. Most of the time I spend most of my time on helping people start and buy pharmacies. But my role today is I am one of the owners in the pharmacies. So I actually have the perspective of not being an accountant. So if these guys getting into things that us pharmacy owners don't understand, I'm here to bring them back down to earth.
Crack the whip, keep them in line, right, Owen?
That's right, yeah.
So, I, as with you, Owen, am not an accountant, just a regular guy, not a pharmacist. So I'm not even thinking about my taxes right now. Maybe I should be. But if I owned a community pharmacy, when would you advise that I start the process of tax planning?
I mean, I think, part of the reason we're having this is taxes, although we don't like to talk about them. I mean, it's so integral to the business, and people always have questions because it's kind of a mystery of, and we get a lot of questions about, hey, how can you help me save taxes, on my tax bill and so forth. But you can't start early enough, right? When you get in, you start looking at, even if you're a startup and you're not making money, there's tax consequences to that. So, in all aspects and timeframes of ownership, there are always going to be tax implications of how the business is performing, whether it's good or bad. And so, I think out of the gate, it does make sense to have those conversations and start, preparing for, it gets more intense right now, right? And
right. I mean, a lot of times people focus on, okay, we're getting close to year end here, or we need to do some tax planning. Really, you don't want to start at year end. You want to start, it starts at the beginning. I think originally you said, when do I start tax planning? You should start at the beginning. It's a whole year process, and you want to keep looking at things as you go. You want to make sure you talk to your finance people, your accounting firm, make sure they know where you are and where you're going. So we understand that. And, of course, with our clients, we're involved with that, and we know, where they're going and have those conversations with them. But that's the decisions. We need to understand where things are so we can help them make decisions about, what kind of taxes can I save this year? Can I make decisions that would defer taxes to a future year, et cetera? So
yeah,
it's an ongoing process.
Certainly one of the implications is you do have quarterly estimated payments typically, right? So, so each quarter throughout the year, you have a responsibility to if you have a tax liability that's going to be due at the end of the year, to make sure that you're paying towards that. So that's why, out of the gate, you kind of need to know which direction the business is headed and make sure that you're making those estimated payments in a timely fashion. If you made them all in the fourth quarter, you're still going to get penalized because you need to make them throughout the year. So,
right. And tax planning is going to help you, determine what your future cash needs are based on, here's where we are, here's where we think we're going to end up, here's some decisions we're going to make that could save taxes, and then what's the implication of that on my personal tax return? And that's going to help determine what my estimates are going to be.
Yeah. And I mean, from my perspective, it's about also kind of goes into your overall planning of, what are you trying to do for the year or for next year, or, maybe just for that quarter, because, that tax planning may, depending on if you're going to take a loss, or maybe you're going to have a huge profit, or you're trying to reduce that profit so you don't pay as much taxes. But there's consequences to all of that. So you may look at, this might be the year that you need to, I don't know, maybe your store needs to be overhauled and kind of has a new look, and you need to get new cabinets and fixtures, or maybe you're going to add compounding or whatever it is. Well, a year where you're going to make a bunch of money, it might be a good time to do those in order to reduce your tax burden, or vice versa. So you're going to be planning those things throughout the year, and you may go, hey, here's my plan. How does that impact my tax situation? So from an owner's perspective, tax planning and your kind of planning as a business in general go hand in hand.
I have a question. And before I ask my question, I want to encourage those who are attending, feel free to ask questions. These three are here to help. So you're going to see the Q&A function at the bottom, the toolbar at the bottom. Feel free to pop in your questions, and I'll be sure to get to as many of those as I can and relay those over to them. My question is, in your experience, do you find, through maybe no fault of their own, that a lot of independent pharmacists neglect tax planning, maybe because they're just too busy or maybe intimidated by it? What's your experience with that?
I think we see, especially people coming to us that have existing stores, and they come to us and ask us about our services. Unfortunately, what we do see a lot is, they get to year end, their bookkeeper closes the books, they hand information off to their tax people and their accountant, and then their tax returns due maybe whether it's March 15th or April 15th for the personal. They get the information and they don't know what's going to, until they get that, they don't know what their tax liability is going to be, right? There was no real planning. It's just, okay, I finished my year, close the books, hand it off, and let's see what happens, what pops up in April, and whether I'm going to have to pay in or get a refund. And so basically, and that's certainly not every case, but there's enough where we see that just don't do any tax planning. So at that point, once you get through year end, there's nothing you can do about it, right? And as Owen alluded to, if you are having a good year and you're considering buying, automation or starting compounding where you do have expensive equipment, the depreciation deduction, as long as those items are put in service before year end, you can potentially accelerate.
Right. There's a lot of things there you can look at, and that's one way you can, help to decrease your tax liability for that year by taking those depreciation, taking big lump sum depreciation in the current year. There's several different methods we can look at there, but that's one of the tax planning things as we talk about it. And two, it's not only looking at, do we do tax planning? It's not just for this year. A lot of times tax planning is going to involve a number of years because the decisions you're making are going to affect a number of years going forward. Depreciation, for instance, you might take a lump sum this year. That's going to help this year, but then in future years, you're not going to have that depreciation. If you make the decision to spread that out over a certain period of time based on what the current laws are in place, you maybe could pay less taxes in the future because you're taking that depreciation and you're offsetting it against higher level income tax rates in the future, which could help in the those future years, but then you're going to pay more this year. So it's all a matter of doing, looking at all those things.
And Brendan, I think a lot of owners do get too busy.
Yeah.
And then suddenly it's just the end of the year.
Yeah.
And I totally understand how that happens. The other thing that occurs is, sometimes people don't want to pay for the consult. So a lot of people will have a bookkeeper and then they'll have their tax person, or they'll have an accountant and they'll have their tax person. And so that tax person a lot of times will, charge you for the return, and then they charge per hour for like a consult or what have you. And so they don't, want to pay for that because sometimes you meet with them and there is no tax. Like they have nothing to tell you because there isn't any kind of tax savings due to, what various things going on in their business or no planning. That's what we occur. But I would say the majority of the time it's in their interest to, meet with their tax people earlier on in the year in order to kind of help them plan and it'll benefit them in most years.
Well, and the other thing that you need to go along with that, right, is to get timely financial statements.
True. Yeah.
Right. And we don't always see that occurring either. So if you're not getting timely financial statements on a monthly basis so you can track the progress of the business throughout the year, it's kind of hard to do tax planning, right? So you got to make sure that you're getting regular financial statements and that you're reviewing those financial statements and you understand the direction that the business is heading. And then you can start taking into consideration, okay, am I going to do a purchase? Am I going to accelerate depreciation? Do I want to, if I'm doing cash-based accounting, which typically pharmacies are, and that's advantageous from a tax standpoint, are there some deductions that I can accelerate? And are there some revenues that I can, push out into a future year or something? So you can do some working, but you got to have your financials in front of you and they've got to be accurate so that you can really understand where things are going to end up.
Yeah, that's a good point. Other things to think about too is, along with that planning is like, if you're planning to sell in the next 2 or 3, 4 years, that might impact your tax planning quite a bit as well. So you may not want to take some of the deductions that you normally would because it could devalue your business. Cash basis accounting, you may not want to do that election. So, again, coming back to some of that planning, if you've got good financials, you can come up with a good plan, which then it makes it a lot easier for your accountant or tax person to provide good advice.
And you just don't want to get to the end of the road and have a surprise, right? And cash is tight and cash is really important to your business. There's nothing that's more important than having the right balance in and that when your wholesaler bill comes out and your payroll on a certain date, that your cash drops considerably. And then over the course of the next 2 weeks, you get your checks from your third parties, your money's coming back in, you build your cash balance up. But when you get down to that, those April deadlines, or even if you extend, you still have to make the payment as of April 15th for your personal returns. So you got to make sure that you understand how much cash is going to be required to pay the tax liability come April 15th. And you just don't want surprises there.
Yes. We have our first question. This one comes from anonymous attendee. Can you explain why cash versus accrual?
Yeah, that's a really important one. And, especially, Jim and my background in public accounting, working in Fortune 100 companies as we have, everything is accrual, right? And everything is focused. And you look at SEC registrations and 10Ks and 10Qs and published financial states and audits, and they're all accrual based. And
generally accepted accounting principles, right? So
yeah,
the old gap thing. So,
but that doesn't always work. And there are allowances in the tax code for small businesses to use cash basis. So I'll give a real quick explanation of the difference between cash and accrual. So cash is based on when the cash moves in and out of your bank account. So if you think about that, you're buying drugs up front, you're paying your wholesaler. When you pay your wholesaler, when you pay your secondaries for those drugs, that is the point that you recognize the cost of those drugs. And you're not just buying, 30 counts at a time. Sometimes you're buying 1,000 count bottle, right? And you're recognizing the cost of that 1,000 count bottle when you pay for it, when the cash moves out of your bank account. On the other side of the equation, you dispense drugs, you get some cash at the register, so you recognize the cash at the register, but the majority of it is going through an insurance. And so that doesn't show up for another 2 to 3 weeks, right? So that's when you recognize the revenue. So you're recognizing cost in advance, and you're recognizing revenue down the road when you actually get paid, when that money shows up in your bank account. As opposed to the accrual, what accrual would say is everything is about the matching principle, and it's trying to match the cost with the revenue. So the cost that's used to generate the revenue. So think about it at point of dispense. That's when everything happens. When you push that bottle to the customer of 30 pills, at that point, you would recognize the revenue on those 30, and you would recognize the cost associated with the 30. So that's accrual, and it's all about point of dispense, whereas cash is about when the cash. So for taxes, put that back into perspective for taxes, you'd love to take deductions early, right? I want to get my deductions, and I want to recognize my revenue as slowly as possible, because with revenue, I have to pay taxes. So it's better to accelerate deductions typically. There are reasons that it might not be if you're going to do some more detailed tax planning, right? But typically you want to recognize deductions earlier and delay the recognition of revenue. And that's what cash basis does. And quite honestly, it's more representative for the typical business owner to look at a financial statement and say, what happened in my bank account? And that's what cash is telling you. Here's what I paid out. Here's what I received in. Here's the net.
But what I always hear from clients, and even our partner, Tim, he would always be like, I just want the P&L to look like my bank account. And he's a pharmacist, right? So what we always heard from pharmacists was, okay, I see my profit and loss statement. It said I made money, but my cash went down. I don't understand. Right. And that it could be that you bought more inventory that month and you have a bunch of inventory sitting out there. You didn't get paid by a third party. There's lots of different things that could cause an accrual profit loss statement not to match your bank account. And so a lot of people like the cash financial because they can say, did my cash go up or down? And that's really simple for a business owner to understand. And, from a tax perspective, again, there can be some advantages to doing some kind of cash or modified cash basis.
Yeah, we could do a whole webinar on cash versus accrual alone. I'll say, again, with accrual, you're going to rely also on the pharmacy system to give you the information, because it's all about point of dispense. And if your information in your pharmacy system is not accurate, which is fairly common, we all know how hard it is to keep inventory and therefore cost of goods in the pharmacy system's accurate. So if that information is not accurate, then your financials aren't accurate. Whereas under the cash basis accounting, it's always accurate. The cash in your bank is what it is. What's coming and going, it is what it is. It's not dependent upon the pharmacy system. So there are some good reasons for both, but typically for small business, it makes a lot of sense to be using cash basis of accounting.
And there are opportunities too on cash basis where, we're talking about making these decisions for cash planning. There's really some decisions that can be made there, especially as you get to year end about, what expenditures, what can we accelerate, deductions into this year. And it helps to be on cash basis from that standpoint. There's a lot of opportunities there with that.
More questions coming in. What kind of expenses are one allowed to prepay before year end is one question.
What expenses are allowed to be prepaid? Well, typically what we look at is, if, let's say for inventory, for instance, if you've bought, made your purchases in the month of December, we suggest if you're on cash basis that you make that payment for those in December so you can actually take the deduction for that. A lot of times you'll get to closer to the end of the month and you might purchase those towards, maybe in the second half of the month, and the payment might not be due until early January. And that's where you have the opportunity to make the payment in December. So you accelerate those payments and that accelerates the deduction of that year. We typically look at things that would maybe be paid in January or in the first half of the month. And those are the items that you would probably pay forward. Utility bills, insurance bills, even the rent for January. Typically, you would pay that on January 1st or, at the end of the month. You want to make sure you pay it at the end of the month so you can get the deduction for it then. It's just a way to move those forward. And one thing to caution you on that is when you do that, you want to make sure that you continue to do that year after year. When you get to the next year, then if you don't accelerate those accelerate those expenditures again and those deductions, then you'll end up with more income the next year because you've taken the deduction from the year before and moved it into the earlier year. So.
What if, Jim, what if your landlord says, I'll take 12 months of rent in advance?
Well, that sounds like something you could take a big deduction for, but the IRS really frowns on that. They're looking at, on a normal basis, what would you make a payment for? And that's something that, 1 month or so, you're going to be okay there because you're making it towards the end of the month or the beginning of the month. But if you made a payment at the end of the year for the whole next year, really at IRS, they wouldn't want you to take that deduction. And we would suggest not taking that deduction. You'd end up recording it as prepaid because it really affects too long of a period there.
Well, and, that just brings up a point that, everybody, you look at taxes and you think it's black and white, and it's really not. There's a whole lot of gray out there, right? And there are people that are willing to really push the limits, and there are people that are much more conservative. Now, in the case of if you're really aggressive, if you do get audited, there's going to be consequences, right? And so, but there's a lot of these gray areas where it's not pure black and white. And there's a decision process that we go through with our clients where we say, okay, I understand your position and there's a level of risk, and we want you to understand that there's a level of risk, and we're willing to defend it, but we don't know if we'll win that. And so there's always a process where we work with our clients to try to educate them about the risks that they're, taking or not taking, and let them make the decisions, unless it's clearly black and white, right?
Right.
Samuel would like to know how to deduct DIR fees on his company's tax return.
So, DIR fees are clawbacks, right? So, there's differing views as to whether those should be expenses down the road. Pretty soon, they're going to be, at point of sale. So we're coming to that point. We view them as a clawback of actual revenue. In some states, that's advantageous, like here in Ohio, where we have a revenue-based tax. We want to reduce our revenues as best possible. So we see those as a reduction and a clawback of revenue, not as an expense. So typically we take them, against revenue.
Right. I mean, if you were accrual basis, you could make a case for saying, we know that at this point in time, how much revenue we've recorded and how much approximately there's going to be DIR fees out there, then you could make an adjustment for that at that point in time. On a cash basis, it's going to be, when they're deducted in the future when the cash is collected.
Yeah, there's an example of where accrual accelerates a deduction or a reduction of revenue, whereas in cash, you do have to wait. Again, cash is going to wait until you actually get, those clawbacks occur and you lose that revenue.
Another question. When do you recognize the third-party payment? Is it when it is deposited?
Under the cash basis, yes, that's exactly when you would recognize it. When it gets deposited in your bank account, when it hits your bank account is when you got the cash, and that's when you recognize that as revenue. And if you were accrual, you would recognize it at the point of dispense. And we had some stores in Illinois, and Illinois Medicaid was 180 days delinquent. So at the point, we were not eligible for cash due to our size, but we were recognizing revenue and not even getting paid for 6 months on that. So
we were paying taxes on the revenue.
Yeah, we were paying taxes on revenue and not
it.
collecting the cash. So
yeah.
Cash basis, you're exactly right. When it hits the bank account, that's when you're going to recognize it. Accrual is at point of dispense.
All right, attendees, keep those questions coming. We've got another one here. This attendee is asking, I'm looking into selling my pharmacy. If I were to sell my inventory at a profit, how will I be taxed?
Well, that would be taxed at ordinary income because you're going to sell that. You've got a certain cost for that inventory. So you sell it just like selling on a normal basis. It's going to be ordinary income flowing through to you.
Typically, you've already got the cost that you paid for that inventory in your financial statements up to that point, and you typically would sell that at cost. We've had situations where you were able to uplift that, but 100%, it would be treated almost as if you sold it to the general public for whatever cost. So that is one piece of the sale that is treated as ordinary income tax rates, not capital gains.
Yeah. And if you're selling your business, we would highly recommend talking to your accountant about your allocation in general, goodwill, FF&E, inventory, all of that, because that can affect your taxes drastically depending on how those are treated.
How they're treated and how they're, what you decide on the sale value for those items, because sellers versus buyers have different perspectives and
the opposite, actually.
Yeah, they're they're on the opposite end of the equation typically in those, how you treat inventory or how you treat fixed assets or how you treat goodwill. So so it's important, to protect yourself when you're going through a sale, to make sure that you negotiate the best outcome for yourself.
Of course, one thing with all of this that you have to keep in mind is, if you're paying taxes, whether that's on a sale or on income that you earn for the year, that's not a bad thing. That means you made money. So, I mean, we hear a lot of people just, I don't want to have to pay taxes. Well, if you're paying taxes, that usually means that you're making, additional profit, or you've made money off the sale. So that means it's a good thing and that you're running your business correctly. I mean, obviously you want to take as many deductions as possible, but, don't, people get so discouraged that they have to pay this tax bill. That means that you're operating well and that your business is healthy. So don't forget that.
Yeah, we get that a lot where, hey, I'm sure you've got something up your bag, a big bag of tricks that we can, throw out at here to reduce the tax liability so I don't have to pay any taxes. And there are certainly some wise tax planning decisions to be made. And we talked about risk earlier and the gray areas. And so there are certainly, areas, but as Owen said, at some point if your business is profitable and it's making money, you're going to have to pay taxes. And so doing that in the smartest way and preparing for it and having the cash on hand to do that is kind of what we really focus on. And there are some really aggressive approaches. You see a lot of R&D credits pushed to pharmacies. That's really hard to justify in most cases and hard to defend if you ever got in front of the IRS on those things. So we see really aggressive programs like that where people approach you and say, hey, I can get you this big tax deduction. But at the end of the day, like Owen said, if there is some tax to be paid at the end of the day, it generally means that your pharmacy is profitable, it's making money, and,
and a lot of times you're delaying the inevitable. It's right, kind of what happening there.
And that's the big thing back to tax planning. I mean, you're trying to decide, in your particular situation, what's the best time to pay that tax. A lot of times you can use, certain things to defer that tax, but eventually, you're going to pay it. So you want to make sure you know the right time to pay it, so you're paying the least amount of tax with the same amount of income.
And that's a good point too. Like Owen said, you're delaying the inevitable. If you listen carefully, most of this stuff is just timing difference, right? You're not permanently avoiding a tax liability. You're just accelerating a deduction or pushing out a recognition of revenue. Or so a lot of it is timing, and it may push it all the way out to the point where you sell the pharmacy. But at some point, the bill is going to become due.
Right. It ends up sometimes you decrease your basis enough that you have a big gain at the end.
There's not a lot of permanent differences, let's say, where you can say, oh, I can take this deduction and never have to have it come back around and actually pay the liability. Depreciation is just accelerating a deduction instead of having a future benefit.
You guys just said two things that kind of triggered questions for me. Is one, like, there isn't a magic wand to reduce your deductions, but what are, common deductions that maybe people do need to look at? I mean, the first one that comes to my head is like a 401k plan.
We see a lot of times where, as we get, you're doing planning during the year and say, we're going to make a lot of money this year. So, we recommend talking to an expert in retirement plans to say, do you have a plan set up? And, is this the year maybe start this thing? And you can put some money away there. That's some really good tax planning, because if a lot of this retirement money you're putting away is going to go for the ownership, right? And you're going to permanently defer that money until you retire in some cases. So you're not paying the tax on it now, but maybe way down the road. Yeah. So that's a lot of things we look at, those kind of benefits, other fringe benefits that maybe the pharmacy might want to start offering now that they're profitable. That's a couple big areas to look at.
Yeah. Also, like we talked about earlier, purchase of equipment, right? So, with the challenges of the labor markets right now, and coupled with the fact that we are seeing, automation come down in price. Yeah. There's some really good automation now that isn't, the $200,000 price point that it used to be. So people are switching to automation, and it's actually, saving some money on the labor standpoint. But the ability to get that in service this year, vehicles, if you're using vehicles for delivery and so forth, compounding, lab equipment,
new pharmacy system, if you're doing a redesign, if you need a new sign.
Yep.
I mean, those are all things, right?
Leasehold improvements, all those types of things.
The key is to buy things you need, and that's going to help you. A lot of times people look at, well, I was planning on making this expenditure next year. Well, maybe you need to accelerate that to this year, because you're going to get it a couple months earlier than you thought, but this year you might need the deduction for that. So that's all things to take into consideration.
And the key there being, buy things you need, right? Don't just go out and buy automation because you're going to get a big tax deduction if you're not going to.
It's just going to sit there. It's not going to do much.
You're not going to truly utilize it and benefit
and save
from
money
it the way that,
yeah. You're not really saving.
Piggybacking off of Owen's question, we have a couple of questions regarding, are there any specific tips or strategies for the 2022 tax year? Anything notably different from previous years that you would recommend?
I don't think there's really a lot of different things. There's things that, like depreciation wise, this year is the last year that you can take on a special depreciation to take 100% deduction. In the future, that was something, for years it was 50%. Back in 2017, 2018, it changed to 100%. It's been that way till the end of this year. Then next year, it's going to go down to 80%, then 60%, 40%, et cetera. It's going to go down 20% a year for the next several years. So if you want to take advantage of that, that's one thing there. Section 179 is still there. That's another convention where you can really write off or expense the asset in the first year that you buy that. That's still going to be there. There's limits on that, but most pharmacies aren't ever going to hit those type of limits. Even meals and entertainment. I should say meals and entertainment, but something enacted last year under the CARES Act for 2021 and 2022. Meals bought at restaurants, business meals are fully deductible, where in the past they've only been 50% deductible. That ends this year as well. There's a couple of things like that are starting to wind down.
If you did take the approach to, the previous administration changed the tax code allowing you to write off inventories under the cash basis of accounting. So if you did take that step and wrote off inventories, they will need to be put back on the books by December 31st of this year. So there are a few, tweaks
that's
and
kind of
changes.
going the other way.
That one's not favorable.
Yeah.
So the new administration adjusted that back and said, no, you can no longer write off, small businesses can no longer write off their inventories. So
when you restore that, then it's going to end up being additional income this
that'll
year.
be income. So again, there's a big, if that is the case, you've got to be aware that, hey, here's what my books show me today, but now I've got this add back for putting inventory back on the books. So that's certainly a tax planning, a key piece of your tax planning equation if that's in your picture.
And here's a question too, and it's on a topic that I know you were you wanted to talk about anyway. How does basis affect you when you sell your pharmacy? Would you have to pay taxes if you have enough basis that match the pharmacy sale price? What are your thoughts on that?
Yeah, and we even put this on our email that we sent out that we would talk about basis. And basis is a really, I think most people don't truly get their head around what basis is. And I think maybe Jim has a little.
Yeah, I mean, one of the reasons, there's several reasons you track basis. You want to see the deductibility of losses. If you have losses, you got to look at your basis to make sure it's deductible or not. And also how you treat dividends, or how you treat distributions, I should say. And the last part of that is, when you sell, what's the gain on sale when you sell your pharmacy? And that's all based on your basis. Basis really is the investment you have as an owner in the pharmacy. And, we kind of talked about an analogy almost, how do you describe this? If you got to compare it to a bank account and your initial investment in the pharmacy, if you put that money into a bank account, then as the pharmacy earns income, that's going to increase your cash and go into your bank account, and then you're taxed on that. Then when you take money out of that, which decreases that bank account, just like it would decrease your basis, there's no tax on that because you have the basis or you've got the cash to actually do that. So it gets complicated in those regards, but you want to make sure you track that. And that's one of the things we've seen a lot of that people don't do. The K-1s that come through on these pass-through entities being, a partnership, I should say an LLC or an S corporation, as they're pass-through entities, and that activity flows through to the owners of those pharmacies. And you get that activity on the K-1 reports that come through on those tax returns. That's what you have to report, or that's the information you use to report on your personal taxes. But you can't just blindly take that information, report that. You've got to compare that to what your basis is to determine the taxability of what's on there, especially when you get to distributions. The importance on basis when you go to sell is if you're in a stock sale where you sold the stock of your pharmacy, that is basically what you've got to compare your sell price to that's going to determine your gain or loss on the sale of that pharmacy from your standpoint when you're selling your stock.
Yeah, again, I think, as simply as possible, basis is the money that you put into your business, right? So if you put $50,000 of your own cash into the business, that's basis. And then as the business earns income, it increases your basis. As it loses, it decreases your basis.
Right.
As you take out money from your business in distributions, not salary, but distributions, if you're an S Corp, those distributions reduce your basis. So that basis is like a bucket of water, and it's getting water added in and it's getting water taken out. And, we can also talk about debt basis. If you're borrowing money to buy the pharmacy, it depends on your organizational structure, whether you're an S Corp or an LLC, that also may contribute to your basis because
right.
You borrowed money and put that money into So basis is a really kind of confusing topic.
Confusing.
Most owners don't understand it.
A lot of people ignore it completely, which they shouldn't.
They do ignore it completely. And so they're just deducting losses on their personals as the K-1s flow through. They're deducting losses when they don't have basis to do it, which could come back to be a problem. The IRS isn't going to audit you looking for, basis issues, but if you are audited and they look at basis issues, it could come back. So basis is really important to track. And it can, part of that planning is, if there is a loss, if you've opened a store, you're going to expect to have losses out of the gate. So how do you make sure to take advantage of, if you pulled money out of your 401k and you created a huge tax liability doing so to fund your business, how do we make sure we offset that tax with some of the losses of the business and make sure you have the basis to do that? So that's we work a lot with basis, and we make sure that we track very carefully the basis and give them the basis calculations to use in their personal situation.
Yeah, that's something you want to track from day one when you start off with your pharmacy. Make sure you keep track of your basis as you go along, because, you could be in business 20, 25 years. And, if there's an issue with your calculation of the basis, it's going to take a long time to go back to the very beginning and figure out what your basis is. So it's very good that you want to keep up on that every year as you go. And as the information that comes through on the K-1, that's the responsibility of the entity to provide that information to the owners through the K-1, but it's not the entity's responsibility to track the basis. That's the shareholder or owner. That's their responsibility.
Rich, I heard you mention S Corp. Under what scenario or scenarios would it be wise for an owner to change their taxable entity type to an S Corp?
That's one we hear a lot as well. Yeah. Typically when you're a startup, there are basis reasons that you might want to be an LLC. But typically once you get to making money and the store is profitable, we can flip you from a partnership or a single member LLC to be treated as an S Corp for tax purposes. And that is not changing the underlying legal entity. If you form as an LLC legally, you'll always be an LLC, but we can get you treated as an S Corp for tax purposes. And that, again, typically comes once you've got positive basis and you're making money. There are advantages to being an S Corp, one of which is that as an owner or a shareholder in the case of an S Corp, as a shareholder, you can be a W-2 waged employee. Whereas with an LLC, technically the IRS does not allow an owner of an LLC to put themselves on W-2 wages, which just causes complications, right? It doesn't make a whole lot of sense, but that's how it's written. And that means that you've got to make estimated payments for your federal, state, Social Security, all your payroll taxes all have to be made through estimated payments. You shouldn't be on W-2 wages as a single member LLC or as a partnership until you've declared for S Corp.
Right. And there's a big advantage of going to S Corp too. When you set your salary and you're paying those W-2 wages, you're only paying payroll taxes on those W-2 wages. If you're a partnership, you're going to pay payroll taxes on all your earnings up to the federal limits. So, for the Social Security part of the payroll tax, that's up to $147,000 this year. And then for Medicare, there's no limit. So all of your earnings as an LLC, you're going to pay the Medicare wage rate, tax rate of 2.9%. So there's a lot of savings that could be involved in that from that standpoint. Plus, like Rich said, just the ease of having W-2 wages, and that will help, limit that payroll taxes. And then any earnings you have above that is all going to be ordinary tax and not subject to the payroll tax rates. That's one of the big advantages of being an S Corp.
Yep.
Rich had mentioned before about, sometimes you want those losses to offset some other income that you might have. We find sometimes that if you're going to start off and maybe you're only going to have losses for the first couple of years to be profitable, we might, recommend, moving to an S Corp a little bit quicker. Because you'll be in that position where on the payroll taxes, you'll be able to, limit those because you're an S Corp.
And so the other corps that you could be is a C Corp, right? And then, I mean, I guess you could be a sole proprietor, which as a pharmacy owner, you probably should try to avoid for the most part. And C Corps too, you don't, I mean, there's reasons to do them. Both. Yeah,
but you're subject to double taxation because, you know, as the C Corp makes money, it's going to be taxed on that at the corporate level. And then any distributions are going to be dividends that are be taxable to the owners as well. So it's double taxation. That's one of the big disadvantages of being a C Corp. That's why we recommend, and most people, you know, independent pharmacies we see are LLCs, whether it be a single member because only one person owns it, or at a partnership because if more than one member owns it, it's automatically defaults to that. And then as Rich had mentioned before, if you're an LLC and you want to convert to S corporation taxation, you can make that election. It doesn't change your corporate entity. You're still an LLC, which is the simplest form of you know, creating your ownership. You know,
C Corps are very hard to get out of too. Like if you need to change, it's a lengthy process, and you know I think they go back you convert to S Corp status, but then there's built-in gains tax you have to worry about, which some of these concepts are very difficult, and then and they do kind of look back for 5 years with on the built-in gains portion of that.
Yeah, if you were to sell your store within the 5 years of converting, it would do a look back. So
right,
there's a lot of, not that it can't be done, but you know that there's a lot to consider when you're doing that.
Yeah.
Even converting to an S Corp, there's things to consider. I mean, if there are losses involved, I mean, like Jim said, maybe even early on, it's good to be an S Corp. So
right, you can generate losses in that first year. Maybe you're going to offset those against some income you have in a year. Maybe you don't. But if you have that loss on ordinary income, then you're going to be able to carry that forward. So in the future years, when you have that income, you can offset that against it and really maybe eliminate a lot of your ordinary income tax. And then you'll just be paying, you know, payroll taxes on your wages, which through the S Corp.
Another question here. Can I carry my inventory at market value instead of cost? And a follow-up comment of to help reduce the ordinary income when selling my inventory at a profit.
No. I mean, generally, you wouldn't want to do that when you're recording it, when you're purchasing it. You know, you pay a certain amount for it. So the only way to have it at market value would be you'd have to write that up, and then you'd be generating income at that point in time that you'd have to pay tax on. And then when you sold it, you would have less income. So that would actually be accelerating.
Almost. It'd be like buying like gold or something. You buy it here, and then it, you know, and when you sold it, you have to pay taxes on the gain, right?
Right. So you really wouldn't want to do that. You want to keep it at the cost, and then when you sell it, you're going to recognize the profit.
I like the creative thinking, though. I mean, that's you got to think and ask.
I saw the wheels turning there for a few seconds.
We were pretty quickly.
We've decreased the tax at the time you sold it. That's for sure.
But
here's another one. Is there a credit for employee relation? If so, what's the deadline to apply?
Is that ERC?
What was that, employee relations?
There are certainly some credits around, especially in the last few years, around what's been going on with you know, the pandemic. That there are ERC credits and other things that are out there that if you are eligible, you can apply for, and those are still ongoing. Jim's done quite a few of those. Most pharmacies, though, what we typically see are not necessarily eligible. You had to have a reduction in revenues, which most of us didn't have drastic reduction in revenues, or you had to be shut down, and most of us were also considered essential. So,
right.
But there were certainly stores that lost money, and there were ERC credits. Are there other employee credits not?
Yeah, I mean, I guess I didn't understand the question completely, Brandon.
Well, I think this person meant to say employee retention.
Retention,
yeah,
okay. That's exactly what they were talking about, where and that's, if you're eligible for that, you can get some pretty big credits on that. Usually at this point now, we're beyond the facts or beyond the time when it was. So you have to go back and file amended payroll tax returns in order to claim that credit. And we've seen with clients, it takes, maybe 4 months or so to actually get the credits. But if you're eligible, you can get some pretty good credits there, because it gave you 50% of the first $10,000 of wages for an employee in 2020. And then when it got to 2021, it was 70% of the first 10,000 per quarter. And that ended up being for the first 3 quarters. So if you're eligible for every quarter in 2021, it would be $21,000 per employee for every employee that made basically $10,000 a quarter, or $30,000 in those first 3 quarters. But as Rich had mentioned, that's looking at, did your revenues decrease 20% in 2021 as compared to what it was in 2019? Or were you subject to a partial or full shutdown by the government? That's where it gets a little gray. It's a gray area there. As we've seen, most pharmacies were not subject to any shutdowns. They were deemed to be essential and stayed open. And a lot of our pharmacies that we've seen actually, increased their revenue during that time period. We did see some that decreased it, and they were eligible for those credits. We kind of caution you out there. I guess it depends on how aggressive you want to get. There are firms out there right now that will tell you that you're eligible for it, and we're not sure what their complete basis is on it. And, they'll make the calculations for you. They'll file it for you. They'll take a percentage of it themselves. That's how they're getting paid. And we just send caution out there because it's a very aggressive approach. And in some cases it might be merited. So you just have to be careful with that, because take this aggressive approach, what's the old saying about, pigs get slaughtered. The first
pigs get fat and
hogs get slaughtered. That's right. Yeah. So you right. Just have to be careful. Yeah.
Right. I do see we're approaching the top of the hour. Do you gentlemen have time for one more question?
Sure.
Okay. Is the domestic production deduction available in 2021 and 2022?
So that's where we're getting into real specifics there, and that would probably be more of a personal. We'd have to look at the facts and sit down with you on that one. We're trying to keep this much more of a high level, emphasizing the fact that, tax planning is really important. And questions like those, while valid, and there's probably a ton of them out there, that's where we need to sit down and say, let's look at your circumstances. Let's look at where, and that's the whole point of this, right? Is let's look at those circumstances. Let's understand them. Let's help you take advantage of the things that you can take advantage of. And just make sure that that you're not paying more than you should be, but also that you're not exposing yourself in a way that you shouldn't be, that are above and beyond the risk levels. And the last thing you want to do is jeopardize your store, right? Because you've taken advantage, or you've really pushed the limits on everything, and when it comes back around. So that's why, the whole point of this was to sit down and just talk about the importance of sitting down with your accountants and your tax advisors, not just in April or March after the year has ended, but throughout the year, to plan, to prepare for what's coming, to look at those specific deductions, which you can take advantage of in your particular situation and your particular state, and even in your particular locality, because certainly there are taxes, local and city taxes as well. So, the importance of that planning, we just can't emphasize enough. And unfortunately, these are complicated topics that need, people that understand them.
Well, to that end, Rich, if someone has a follow-up question for you or Jim, what's a good way to get in touch with you to pose those questions and maybe learn about some of the services that you offer?
Yeah, again, we're Independent RX, and you can reach out to us through our website or I think we were on the emails and so forth. And we are a little different than your typical accounting firm. We didn't set out to become an accounting firm, although I think we've got 5 CPAs on staff, from most of them from, big 4 accounting firms. But we don't charge by the hour. We typically only work with our clients. We have a monthly rate. You can call us when you need to talk to us. We don't, charge you when you pick up the phone and call us. That's how we prefer to work with our clients, as opposed to, every time you call in, the meter starts running. So, but we'd love to talk to you. We do, people that are interested in us we do the bookkeeping. We do the tax work. We pull your information off your pharmacy system. So we're looking at how your pharmacy is performing operationally, not just financially. And we work with clients in that respect. So if you're interested in talking to us, we'd love to talk to you. We can tell you more about our services. We often have people give us a copy of their last tax return and their financial statements, and we look at it and we tell them what we see. Is it really well done? Is it good? Are there differences in how we would look at it? Is it problematic, right? So I think that, yeah.
Yeah, our website's independentrxconsulting.com. But if you Google us, we'll come up.
Gentlemen, any other final thoughts before we wrap things up? Final lasting words of wisdom?
Well, we've got lots of those, Brendan, but they may or may not want to hear them.
It's not webinar friendly.
Yeah. Taxes aren't the most exciting topic, but it is an important part, and that's why we're having this 4-part series. We appreciate IPC, sponsoring this for us and working with us on this. So we've got one more coming, but taxes aren't always the most exciting topic, but they're really important, especially this time of year as we're closing in on year end. So we really appreciate it, Brandon.
Yeah, thanks, Brandon.
Of course, yeah. We're thank you for the opportunity to partner with Independent RX, and very important topic. And I'm not a tax guy. I'm not even a pharmacist, but I learned a lot today. So thank you. And thank all of you out there who took the time out of your busy schedule to join us here today. We know you're busy. And if you have a colleague who you think might benefit from this discussion, just know that this is being recorded and will be available soon on Independent RX's website. Also, as Rich kind of alluded to, the final webinar in this 4-part series is coming in November. So look for an announcement later this fall. Again, thank you so much. Have a great rest of the week.
Thanks.